The reason it's so interesting to learn about efficient markets is not only that we learn about some important economic concepts, but there's a lot of practical relevance here. And for most economists, the efficient market hypothesis delivers some very practical, very sensible financial advice. To start off with, I want to think in terms of behavioral economics. Now, behavioral economics has established a number of so-called behavioral anomalies, i.e. instances where people don't behave in the way in which we would think if they're following the rational actor model. And it can be tempting to think that the evidence of these behavioral anomalies implies that markets are inefficient. And the purpose of this presentation is to say that this is not necessarily the case. Any form of market inefficiency is an implied profit opportunity. So the ultimate test of behavioral finance is to question whether or not it can be used to generate above market returns. And this is the context in which we're going to look at the following concepts. I'm going to make three key claims in the presentation that follows. Firstly, I'll concede that it is possible to beat the market. However, the second point is that the expected returns of trying to beat the market are negative. And thirdly, it is very rare to beat the market over time. To start off with, let's consider random walk theory. If we look at the share price of a particular stock today, it's a function of the share price of that same stock in some previous time period. If we have historic data relating to past price movements, we can use that to try to predict future movements. But empirically, what we tend to find is that past stock price movements can't be used to predict future movements. In fact, the critical factor affecting the movement from one period to another is this epsilon term. Epsilon, in this case, essentially stands for new information. But by definition, new information is impossible to predict in advance. Therefore, markets seem to follow a random walk. The caveat we should add to this is that generally over time stock markets tend to rise, and so really we should say an individual share price follows a random walk relative to the market. Now this is a very important finding. The classic book is Burton Malkiel's A Random Walk Down Wall Street. In it he says if the random walk model is a valid description of reality, then the work of the chartist, like that of the astrologer, is of no real value in stock market analysis. Indeed, all the time that people spend poring over historic charts looking at past price movements is essentially worthless. He also says the challenge of the random walk theory to the proponent of fundamental analysis is to show that his more complicated procedures are actually more profitable than a simple random selection policy. As in the case of the chartist, the challenge is an empirical one. And this is a big claim. Lots of people in the finance industry pore over charts. Lots of people engage in fundamental analysis. The implication of random walk theory is that that's a waste of time and money. Now, random walk theory ties into the concept of market efficiency, which is often split into three separate forms. Weak form market efficiency says that market prices reflect all historic information. This is essentially random walk theory. Semi-strong form market efficiency says that market prices reflect all public information. So all publicly available information is already embedded into a share price. A strong form market efficiency is that market prices reflect all public and private information. And we can measure many market settings based on the extent to which information is made available and allowed to be reflected into the market price. According to Eugene Fama, the 6 lessons of market efficiency are, firstly, that markets have no memory, so financing decisions shouldn't be dictated by market movements. Secondly, to trust market prices. Experts don't know more than the market as a whole. Thirdly, to read the entrails, to consider the fact that the prices do contain information. Fourthly, no financial illusions. Creative accounting doesn't work. Fifth, the DIY alternative. We don't need companies to merge in order to diversify investors' risk, because investors can diversify our risk ourselves. And finally, seen one stock, seen them all. The idea is that the stocks are close substitutes that only really differ in terms of risk and return. Now, the greatest testimony to random walk theory is the rise of index funds. This is when you buy all or a representative sample of the securities within a specific index. Index funds are incredibly useful because they allow us to form a general impression of the market movement and a measure of short-term changes. They provide a yardstick with which we can compare managed portfolios. But not only can we use them as a basis of comparison to see whether managed portfolios do well, we can invest in the index funds themselves. These tracker funds tend to be low cost, low risk, and interestingly, very hard to beat. Now, the first claim that I was going to make is the concession that it is possible to beat the market. The efficient market hypothesis implies that markets are efficient. But if markets are efficient, where do profit opportunities come from? This is the ultimate paradox in terms of market pricing. But then the question is, what are market prices? In the words of Ludwig Lochmann, equilibrium prices reflect nothing but the daily balance of expectation. In other words, the daily balance of expectations provides equilibrium prices. When expectations change, the balance changes, prices will move. This balance will be in constant flux. And any time that we're not in equilibrium, therefore profit opportunities will indeed exist. Therefore, the existence of profit implies a couple of different things. If we notice profit opportunities, we could conclude that the market is inefficient, i.e. that the market is generating above market returns. But the second claim that we can make is that the market is in disequilibrium. And ultimately, economists make a choice on this margin about whether or not profit is signs of inefficiency or merely a sign that the market is in disequilibrium. It's possible that markets are in disequilibrium, and it's profit that's providing the signal mechanisms to move markets towards an equilibrium. Indeed, profit opportunities tend to be fleeting moments. According to a particular study, the analysis unveils the existence of numerous short-lived arbitrage opportunities, whose size is economically significant across exchange rates and comparable across different maturities of the instruments involved in arbitrage. The duration of arbitrage opportunities is on average high enough to allow agents to exploit deviations from the law of one price, but low enough to explain why such opportunities have gone undetected in much previous research using data at lower frequency. So we can detect profit opportunities, however they are incredibly fleeting. We can see some empirical examples of this success of large mutual funds relative to a simple index fund such as the S&P 500 benchmark. This study suggests that around 97.6% of managers underperformed relative to the S&P 500, whilst 2.4% overperformed. This gives an indication that whilst it may be the case that we can outperform the market, it's relatively rare. We can look in more detail at the distribution to see the odds of success. And this finding suggests that overall from 1970 to 2000, over that 31-year period, around 60% of funds no longer existed. 60% of the time, the fund completely disappeared. If we look at those performers that did better than the market, we see there were 19 funds that outperformed the market, but this only translates into a 5.5% success rate. So we may conclude that empirically, yes, we can beat the market, but how confident are we that we've selected one of these 5.5% of funds? This brings us to the cross-sectional problem. This is a hypothetical example I've put together with three different funds: the blue fund, the green fund, and the orange fund. Now imagine that we are looking at the average return, and let's imagine we're looking at 2006. Well, in 2006, we can clearly see that Fund A is the highest performer. If we're making a decision in 2006 as to which fund we wish to invest in, we may be tempted to go for Fund A given its past historic performance. However, when we fast forward a year and we make our decision in 2007, we'll see a very different picture. In 2007, Fund A is the lowest performer, and in fact Fund B is now the highest performer. The problem here is that when we're taking this snapshot at different periods of time, what we're actually looking at is volatility rather than returns. At any particular moment in time, the highest performing fund is likely to be the one with the greatest variance rather than the greatest annual return. This implies that the winning traders tend to be the worst over time, and therefore the worst investment strategy is to simply pick last year's winners. Note that this is what many people actually do. They'll be disappointed in the return of their fund, and therefore they'll move their money into the highest performing fund of the previous year. In our example, we'd really want our money to be invested in Fund C, the orange line, which generates a steady positive return. The second claim we're making is that the expected returns of trying to beat the market are negative. A New York Times article pointed out that investors collectively spend around $100 billion a year trying to beat the stock market. And yet the remarkable result is that returns are higher for broad indexed funds than managed funds. Indeed, after costs and taxes, an indexed investor in a market can beat the average active investor. This presents a very interesting finding, which is why would people spend so much time and money trying to beat the market if the expected returns are negative? This doesn't necessarily mean people are irrational. It may be that they are enjoying the fact that they are trying to beat the market. Consider the game of roulette, for example. Everybody recognizes that the expected value of a roulette game is negative, and yet people still play it. The reason they play it is that they get satisfaction from trying to win. We can apply the same thing to managed funds and say some people may generate satisfaction or utility from attempting to beat the stock market. But it's important to recognize that they're paying for the thrill of gambling rather than the expectation that they'll do better than an indexed fund. According to this Halvarian article, an investor who bought a value-weighted portfolio of stocks in the New York Stock Exchange in 1926 and held them until 2002 would have earned an average annual return of 10%. By contrast, an individual who bought in 1926 and then moved their money in and out of the market in the same pattern as the average dollar invested would have earned a return of only 8.6%. Over this long period of time, the returns are higher for people that put money in the average portfolio and simply sit it out. As Megan McArdle has said, the stupidest thing you can possibly do with your money is what most Americans do. Either buy and sell individual stocks or carefully analyse the list of mutual funds to see what the best ones are and then plough all your money into them. She says you can't beat the market, and neither can the jerk on the phone trying to sell you stocks. Put your money in the broadest possible index fund and leave it there. Don't even peek. Throw the statements away unopened. Rebalance once a year to keep your money at your target allocation and otherwise don't think about it. If you want the thrill of gambling, go to Vegas. At least they'll give you free drinks. The third point is that it's very rare to beat the market over time. As Nassim Taleb has said, the larger the sample size, the more likely we'll see a winning streak. The key issue to find is that if we do see evidence of people beating the market, can they sustain it over time? We would expect, even if it's down to randomness, over a reasonable time period, some market participants would be able to beat the market. But is that any indication that they'll be able to continue doing that into the future? As Burton Malkiel has pointed out, empirically this is not the case. He says the problem is the people who beat it in one period are not the people who beat it in the next period. He looked at how mutual funds performed in various decades, and he said that the best mutual funds of the 1960s, they beat the market 2-1, but in the 1970s they were much worse. If we look at the best funds of the 70s, they were terrible in the 80s. The best ones in the 80s, terrible in the 90s. If you look at the best funds from 1997, from 1998 and 1999, where these were 2.5 times as good as the whole market, they were 3 times worse than the market in the early 2000s. A nice example of the difficulty of picking stocks is the trading market's Playboy 2006 stock picking contest. This is when Bill Miller of the Legg Mason Value Fund was investing money, and his investment decisions were judged against a selection of 10 Playboy models. Bill Miller is one of Businessweek's Best Fund Managers 2006. He'd beaten the market, measured as the S&P 500, for each of the last 15 years and managed a fund size of over $12 billion. The question is, who would you rather have looking after your money? Bill Miller or the 10 Playboy models? When we look at the results, we see that the Legg Mason Value Fund, managed by Bill Miller, generated a return of 6%. However, the Playboy models collectively generated a return of 8.6%. Does that mean you should give your money to the Playboy models? Well, not necessarily, because over this time period, the S&P 500 delivered a return of 12.9%. Once again, index funds are best. There is an important footnote to point out, which is that in 2004, Miller did better than the weighted average of S&P stocks, but worse than the simple average. So depending on how you calculate the average, sometimes these figures can slightly adjust. Indeed, during his winning streak, there were more than 30 12-month periods where he was below average. It's just that none of these happened to run from January 1st to December 31st. So when we're measuring these, the time periods matter, the specific index fund matters, the period over which we're measuring the average makes a difference. But overall, the key empirical point is that it's very difficult to find examples of sustained success relative to a simple benchmark. Bill Miller's return ultimately was 6%. The highest performing Playboy model was Deanna Brooks, who generated a return for her fund of 43%. And if you want to get some investment advice from her, her top pick was Yamana Gold Inc. And as you can see, this study took place over 2006-2007. You can see the high price of gold in this period, and this is what was driving her performance. Her justification for this was, what girl doesn't like a little bling? I'm hot for gold this year. Often when I present this, people think that I'm doing this as a way of mocking the idea that Playboy models could be more effective investment advisors than Bill Miller. That's not necessarily the case though. It could well be that people in a different circumstance or situation can see market trends and have glimpses of the future that are going to be more accurate than people that are all within the same finance industry. Her identification of gold was in fact actually quite astute. At this point, many people say, well, what about Warren Buffett? And they think of specific examples of people who have a long track record at very high sustained financial performance. Well, it's important to consider what Warren Buffett actually says himself. In a 2016 letter to shareholders, he said, "Over the years, I've often been asked for investment advice, and in the process of answering, I've learned a good deal about human behavior. My regular recommendation has been a low-cost S&P 500 index fund." Interestingly, Ted Sades of Protégé Partners challenged him, and the two of them agreed to take out a bet. They made a bet that over a 10-year period commencing January 1st, 2008, ending December 31st, 2017, whether or not the S&P 500 would outperform a portfolio of funds of hedge funds, once performance has been measured based on a basis net of fees and costs and expenses. So Buffett took the bet. He invested in a Vanguard index fund, which is the originator of index funds and a very famous company. And his opponent Sades picked 5 hedge funds of funds. In 2017, the result became clear. You can see that Buffett got off to a bad start because in 2008, the S&P index fund fell by 37%. However, over the following years, the S&P made up this ground. And when you look at the overall result, you'll see that the average of the fund of funds, the mutual funds average, was 2.2% net of all fees, whereas Buffett's return from investing in the S&P 500 index fund was 7.1% compounded annually. If you want investment advice from an economist, there you have it. Put your money in a broad index fund as low cost as possible, and your return will be higher than the majority of people that waste so much time and so much effort trying to beat it. For more details and for more insight on the behavioral anomalies that I started this presentation, see Chapter 11 of Markets for Managers.